Adjusting entries are required because U.S. GAAP requires the accrual basis of accounting. Okay, so let's talk about the basic difference between the accrual basis and the cash basis. The cash basis of accounting is something that is only going to be used by very small businesses. Okay, publicly traded companies are not permitted to use the cash basis of accounting. Under the cash basis of accounting, revenues and expenses are recorded based on when the cash is received for revenues or paid for expenses. Okay. Again, a small business may be able to use this, but for our purposes, we are going to use the accrual basis of accounting because that is what is required under generally accepted accounting principles, and that's what publicly traded companies must follow. Under the accrual basis of accounting, we will record revenues when they are earned, and we will record expenses when they are incurred, regardless of when the cash is paid or received. And by doing this, we are able to better match our expenses against the revenues they help to generate, which gives us the most accurate possible picture of net income. So let's talk about our adjusting entries. We have 4 basic types of adjusting entries. We have 2 accrual entries and 2 deferral entries. Now, let me say that not every single company will have to make all 4 types, and some companies may have to make multiple entries associated with each type. It's going to depend on the size and structure of the company, okay? But let's talk about our accruals, okay? We have accrued revenues and accrued expenses. And again, these are adjusting entries. So when would we record accrued revenue? We would record an adjusting entry for accrued revenue when we have performed work or provided goods to a customer, and that customer has not yet paid us. Okay, so we've done the work, we've earned the revenue, but the customer hasn't paid us yet. That adjusting entry would be a debit to accounts receivable because the company owes us. Remember, accounts receivable is an asset, and a credit to revenue to increase. So in this case, we're increasing receivables and also increasing revenue. All right. The second type of accrual is an accrued expense. This is an expense that we have incurred, but we haven't paid it yet. The adjusting entry is going to be a debit to the expense account and a credit to accounts payable. Okay. Similarly, we have 2 types of deferral entries. The first deferral is deferred revenue, also called unearned revenue. Now, this occurs when a customer has paid us in advance and we have not yet performed the work. Okay? So when the customer initially pays us and we haven't done the work yet, we record this entry here. We do a debit to cash because the customer gave us cash, and we credit this account called unearned revenue. Unearned revenue is a liability account. It's a liability account because we owe that customer work. Could be goods, could be services. We owe them something. Okay, so that's the initial entry. Now, at the end of the period, we look back and say, well, what portion of the work have we done? Whatever portion of the work that we've done, we move out of unearned revenue by debiting the account. Remember, unearned revenue is a liability account. So when we debit it, that's going to decrease it. We move it out of unearned revenue and we move it into earned revenue because we have now earned that portion of the money. Okay. Similarly, a prepaid expense. Okay. Let's look at what happens when we initially prepay for something. For example, let's say that we pay a 6-month insurance policy up front. Okay. When we pay for it initially, we're going to record it as prepaid expense. Now, this is important to remember. Prepaid expense is actually an asset account. Okay, sometimes you'll just see this listed as prepaids or prepaid assets, but prepaid expense is okay too. But a prepaid expense is an asset account. I know that's a little bit counterintuitive, so that's why I wanted to highlight that. So when we initially pay for that insurance policy, we're going to record it as an asset. Okay, so we're going to debit this prepaid expense account and credit cash. At the end of the period, we're going to say, well, what portion of that asset have we used? For example, if we paid for let's say that we paid $600 for a 6-month insurance policy. At the end of that first month, we would say, well, 1 month has expired. We've used 1 month of that $600 6-month insurance policy. So we are going to move $100 out of the prepaid expense account, that is out of the asset account, and into the expense account. This is the regular expense account that hits the income statement and affects our profitability, our net income for the period. Okay, so those are the 4 types of adjusting entries. So with those adjusting entries, guess what? We encounter some new account types. So here is an example of an expanded chart of accounts, okay? And you see this one has some additional accounts on there compared to what we saw on the last chart of accounts. We see some new accounts listed here. And this commonly happens as we are recording adjusting entries. We are sometimes going to use different accounts than we might use for some of our transactions that occur regularly throughout the accounting period. So what we see here is an example of what a summary of adjusting entries might look like, okay? So for example, this company has a variety of adjusting entries that they're going to record here. The first one is some accrued revenue. It looks like they have done some work for customers that the customers haven't paid for. So they're debiting accounts receivable, crediting fees earned, which is a revenue account. Okay, so they're debiting receivable, credit revenue. It looks like employees have worked for a period of time that they haven't been paid for. This is an accrued expense. So they're debiting the expense account, crediting the payable account. Okay, and you can see the rest of these examples as well. Okay. And lastly, once all of those adjusting entries are made, we can prepare what is called an adjusted trial balance. This is essentially the same thing as the unadjusted trial balance. This one just has more accounts on there. But the adjusted trial balance will list every account that we have on the general ledger along with its respective debit and credit balances. And one thing that I'll point out here, when doing any sort of trial balance, we only include the net balance. For example, cash is going to have a net debit balance. Now, throughout the period, we've recorded lots of debit and credit entries to cash, but we're only reporting the ending balance here. Okay, so for each of these accounts, you will have a debit or credit balance, but not both. Okay, so you're only reporting the net balance. Okay, but one thing to keep in mind, total debits and total credits should still equal. If they do not, then it means that there has been an error made somewhere.